Here on Jay's Corner, of course I couldn't do it alone. I've had the support of many. At the top of the list is Bob Powell. He's a financial journalist, an icon. He's widely quoted in pretty much every location. He knows tons of people. He'll mention them here on today's interview. We welcome him back after a year and a half. Hope you enjoy. So we welcome back Bob Powell to Jay's Corner. Welcome, Bob. Thank you for joining me again here today.
Jay, it's always a pleasure to be in your corner.
And now we've reversed roles. Usually I'm the one answering your questions and things like that. And now I'm going to put your feet to the fire. So I look forward to this.
I'll do my best.
I'm sure you will. Last time we talked about the crazy run for Boston sports. The worm has turned, Bob.
Yeah, it's turned in Philadelphia's direction or New York's direction, or I'm not sure. It's not the only team that we have going for us right now, Jay, is the Bruins. They're doing really well. The Celtics are off to a mediocre start. Obviously, the Patriots are having their woes, though. Last week was a pretty good week for us, and of course, the Red Sox. Who knows? I don't know what's going to happen there.
Well, the Bruins and the Celtics have had headlines for the wrong reasons over the past couple of days.
Yeah, the Bruins kind of shot themselves in the foot. And
that's what I heard, right? Somebody wasn't correctly vetted from a childhood or something.
Yes, a somewhat young hockey player who was originally drafted, I think, by Arizona, had some problems when he was 14 years old and had tormented a black disabled child, and it's haunted him ever since.
That is
so.
There are certain lines. We have forgiveness in our society. That there are certain ones that are going to be real tough to overcome.
Yeah, and I think this is a case where the kid was 14. He's now, I think, in his early 20s or so, and maybe there's a thought on the part of the Bruins front office that maybe he had redeemed and repented, but the NHL, Gary Bettman weighed in and said he will not be playing anytime soon in the NHL. So the Bruins had to reverse course and terminate the contract that they had offered him.
Wow. So,
yeah, it was a fiasco.
It's incredible.
Yeah. Meanwhile, I let me share this with you, Jay. Speaking of the Boston Bruins, I had played golf on Sunday, and then we stopped at a local restaurant to grab a bite to eat, and who walks in and sits down exactly right next to us is Ray Bourque, who
really,
yep, who had played for the Boston Bruins.
Oh yeah,
for almost his entire career before he left to go to the Colorado Avalanche and promptly won the only Stanley Cup that he ever had ever won. And so anyway, we were sitting next to him, and my son went up to him and asked if he could have a photo, which he graciously agreed to do. And my son told him that the very first time that he ever stayed up past midnight was because I let him watch the Colorado Avalanche win the Stanley Cup. He was all of 6 years old, and he had to stay up till midnight plus in order to watch, Ray Bourque with tears in his eyes skate around with the trophy in his hands. So it was quite a thing to meet a Stanley Cup champ and hometown legend.
Was this like a small local restaurant, or was it?
Yeah, it was just a small little local restaurant next to the golf course where we played, and he walked, and all our jaws dropped. Everyone in the restaurant jaws dropped because he just walked in.
Did everyone know who it was?
Everyone knew who he was. Yeah, I mean he's impossible. He's impossible to not know that it was him, right? He's a big beefy guy with a recognizable face and big smile, and we were all like, "Oh my God, that's Ray Bourque!" So
that's pretty cool. I'm sure if he walked in today, I wouldn't know who it was. So I mean, I wouldn't have known. I didn't follow. Well, of course, being from Michigan, the Red Wings at that time, very big, just prior to when the Avalanche started to get good and things like that. So those days were all changed. And your daughter went to Wisconsin, right?
She did, yeah. So by the way, since you're in Michigan, I have to tell you my other brush with fame story. I was at an airport going through the TSA line,
right?
And who strolls in behind me but Juwan Howard. And
very unmistakable.
very unmistakable. Anyone could recognize that it was him. And I looked at someone next to me and I'm like, Juwan? Like, yeah.
Not many 6'10", 6'11" people on the planet, right?
No, and I didn't want to tell him that my daughter went to Wisconsin, given what happened to him the last time
Right.
they played each other.
Boy, that was very college sports have really taken it in the chin. I mean, and some of the off the field stuff. My goodness, there's this Michigan State fiasco. You
Oh
saw
my
that,
goodness.
and it's
Yeah.
just like, I don't know. I mean, rivalry is one thing, but I don't get to opine, right? Because then I look too much like a homer, right? But I mean,
Right. But that was
holding someone down and
right.
swinging a helmet.
Yeah, to watch the video of that is to think that something went wrong there with the
It's
coaching
just
staff.
unbelievable.
Yeah.
Unbelievable.
Yeah.
So
And it's it's interesting because we hold our athletes up on this pedestal
yeah,
and not and perhaps not deservingly so, right? We expect them
right.
different than average human beings, but in many ways they're not. They're just particularly good at whatever, hitting a golf ball or throwing a
Yeah, I
football.
don't have a problem with the fact that, we're not going to athletes for, intellectual ideas or, philosophy ideas, but, to cross the line for clear assault is just like crazy. I mean,
Yeah.
I've struggled to find what the explanation is. Well, thankfully, it seems like the coach and has expressed, look, we're going to lay it down the line, suspending the players immediately and, as far as they could see, and then let the rest take its course. I mean, both, I can tell you in Ann Arbor, both schools have had very nasty headlines from, academic, like, the president from the University of Michigan, ejected.
Right.
Obviously Michigan State and University of Michigan having coaches with wrongdoing in the past of terrible nature has just been not a very good set of a period, actually probably since we last spoke, of fairly long litany of not very pleasant things going on. So I thought that away from sports talk, sports talk.
You should be happy you're not talking to my son, who's a football fantasy football addict, and would talk for hours about who to draft and who to pick and who to
Oh,
drop.
okay. Wait. Is he on like season long or daily? Is that which one?
Oh no, I mean he has his own homemade podcast on Sunday mornings, and aside from that, I actually had golf with him on Sunday and spent however many hours listening to who I should draft and who I should drop and who et cetera. And I have to admit I don't even do fantasy football because I realized it would take up far too much time to actually be good at it, I think.
Oh, it's crazy. So I on Jay's Corner, part of the whole message, right, has been, look, there are these techniques when someone's putting a portfolio, modern portfolio theory. And reality is that I've been telling persons, look, this actually looks a lot more familiar to what people are doing when they are putting their fantasy football teams together.
Right.
A lot.
Yeah.
Right. Because you're trying to get the highest average score and then you're trying to have these combinations that work. And it's so extreme that, in daily fantasy, I'm not sure if all the different contests. There are these different contests where, you only get paid if you win, like it's very, very top heavy. So you're tweaking modern portfolio theory so that the quarterback is throwing to that wide receiver. So in other words, in when you're managing your portfolio or you're thinking about portfolio, you're thinking about lowering your correlation across asset classes, right? In order to, and yet trying to get the maximum return. But in daily fantasy, while you're trying to have the maximum return, you're trying to turn up the knob on correlations so that when you have a particularly high scoring game, or you've got a quarterback throwing to a particular receiver, you're teaming them up intentionally,
right?
Where you can't do that for season long, because if that goes wrong, they lose, you're sunk, that kind of thing. It's so, and it's funny that the people that I've got a couple of friends who are scientists first,
Right.
and I'm like, and we talk about sports, and I said, all you have to do is just think about what you already know and just turn the dial slightly, and you get to these different topics.
Yeah.
And, diversified portfolio on one hand to fantasy sports is actually not as unrelated as you might think. And have you seen these websites about daily fantasy, Bob, or fantasy sports?
No,
Well, they're running correlations on the site. They're running projections to get the maximum, expected return,
yeah.
and then tweaking based on, these correlations. It's crazy.
Yeah. So you reminded me years ago, I had a neighbor, he and I tried to do a startup out of his garage. He was a statistician and had done work for Rick Pitino
Okay.
when
Wow,
Pitino
cool.
coached at Boston University. And then later when he came back to the Celtics, they hooked up again. And it was really an early version of Moneyball in a sense
Yeah,
for basketball. It was the
sure,
thought of
sure.
which combination of players should be on the court and for how long and in which game situations, down by 10, up by 10, et cetera, et cetera. And it was really interesting because Pitino relied on this system when he was here with the Celtics, and also and going back to his time when he was coaching the Boston University Terriers. And then along the way, my neighbor got mistreated by the other assistant coaches for the Celtics, and so he decided to strike out on his own. And I was helping him launch his business, and it was interesting because there were other players already in that world, like Stats Inc., who were doing something similar, but not exactly the same. But they had already an installed customer base, so it was really hard to crack the so-called lineup in the NBA. At least we ended up getting a few college basketball teams, but along the way, I got to meet Jerry West and Mitch Kupchak, and
Cool.
and I got to meet them in LA, at the Staples, and I sat down to talk to Jerry West and Mitch Kupchak about this system. We called it
Right.
Optometrics. And Jerry West, I'll leave out the swear words, but he was like, "We don't need no stinking statistics. We coach and manage our teams, with gut instinct. We don't need numbers to tell us what to do."
Well,
So,
now look.
yeah. Yeah, that was like 20 plus years ago when we were trying to get this up and running. So yeah, now look, now we have microchips in people's sneakers, right?
Well, now also the other thing is that who was that? The Mavericks. So Mark Cuban had actually hired somebody called Haralabob Bulgaris, I want to say, whose background actually is as multimillionaire from basketball betting.
Ah,
And what he was doing is he was keeping very careful statistics. There's all sorts of podcasts about him
yeah,
and his story, because he was hired by Mark Cuban to be kind of like in very high management. I can't remember if he's like, director of player personnel. I mean, very high up,
interesting.
right? So,
Yeah,
all of that had come full circle to some degree. And then, they had some personality conflicts in Dallas, but that whole technology had actually reached, the upper management, and now, Mark Cuban deploying it, or believing it and trying to do that. And it not coincidentally tells you that the other link, which is that, and, hopefully you have better things to do, but on Jay's Corner, there are hours of streams of me playing in small stakes poker tournaments.
ah,
Because not, and actually this person from the Mavericks, he's actually on these very high stakes poker TV shows on YouTube,
interesting. Have you played?
where, people are buying for like, hundreds of thousands of dollars they're bringing to the table. But because poker now is completely a game theory optimal, these guys are talking about Nash equilibrium. They're running simulations overnight to find what the proper approach and the proper betting and et cetera, et cetera. There's an entire industry which now, has taken a bunch of math. And, with this, it's not the idea of, like you said, we don't need no stinking statistics. And it's so incredible that there have been scandals about cheating,
Yeah.
that people would have real-time assistants running the simulation while you're playing poker online to figure out what the mathematic combination and what is optimal, the optimal action or reaction to be. It's been, this explosion.
It's pervasive, right? It just happened in the world of chess, right? Where
Exactly.
right, where we had a world champion be accused of cheating, and his opponent
No, that's
resigned
right.
after one move, right? One move, he resigned, accused him of cheating.
I think that, they had amassed the amount of data, because these are so related, right? Because of the fact that, chess too, and I barely know. I mean, I know the rules, but I would not call myself a chess player by any means. But there's all these openings and patterns, and everyone has the first set fully memorized, like completely memorized, right, up to a particular point in time, and then and only then, are there then variation? There are variations on these themes that are all, they're running simulations about what is exact. And so I had seen some other videos on examining the person accused, and other of the best players in the world had watched it with the simulator and say, okay, this is not possible,
right?
That a human could do that on the fly. You see what I'm saying? In other words, that, so, when they ran it with the simulation, they ran a couple of the accused games and saying that, he's run it with he's played this game with 98% perfection compared to with a computer. You see what I'm saying? So it's not just a random one-off poker hand.
No,
no. Random one-off poker hands because someone's had too much to drink and and lets their ego get in the way or something like that. But the idea that you would have simulations on chess and then also randomness to 98% accuracy with the simulator, that's, so the conclusion had to be at that point is like, that's got to be wrongdoing,
right?
Like there's like no, but it's just been crazy.
Yeah.
So speaking about back breakdowns of these correlations, I thought we would talk about your world and all the different inputs, your different comments on the street.com, Retirement Daily, all the things that you've got going on.
So
It's been crazy to hear about.
I'll share with you. I think I didn't think I would cause such a ruckus when this appeared, but I wrote there was some research done based on the life cycle savings, life cycle theory of finance, and or life cycle hypotheses. It goes under various names. And the theory is that what people want, and Modigliani won a Nobel Prize for this. Let me just say that at the outset, right?
Right.
And he won a prize that ultimately said that what people want throughout their life is smooth consumption, and that when they're young and their income is low, that they ought not save for retirement. That they dis-save, that perhaps they take out loans to buy a house or invest in their human capital or whatever the case may be. And then as they reach middle age and their income rises above their consumption level, that then they now have the income to save and save even aggressively for retirement. And then by the time they reach retirement, they've built up a nice little nest egg and their consumption will stay the same as it did during their working years. Well, so the headline to the story was, and to their research report was that young people should not save for retirement. And you might as well have thought I said, everyone should jump off a cliff, with cement boots on, because the comments were everyone to a person said, "Are you nuts? I would never tell a young person not to save for retirement. Like, in what world does that even make sense?" And I'm like, well, in the world of life cycle finance, it makes sense. And if you subscribe to this hypothesis, then it makes perfect sense that you don't want to have lumpy spending over the course of your lifetime. You want to maintain a certain standard of living. Now the challenge, I think, of course, is there's the theory and then there's the reality, right? So in theory, my income might rise when I get to be middle-aged, but in reality, maybe it doesn't, right? Maybe it stays the same. And in which case, then I wasted a lot of time having a higher standard of living than I should have, right? In the hopes that I would be able to save later. And so maybe the better thing to do, and when I asked the author this, I said, it's kind of interesting. What if things go wrong, right? Like what
Right.
if, right? And he said, well, I'm not telling you not to save. I'm just telling you not to save for retirement. I'm telling you, you could save for an emergency, right? For something like that happening. Maybe you're injured and you can't go back to work, or maybe you're buying disability insurance to prevent the manage the risk of being disabled. I'm just saying, you don't need to save for retirement until your income supports that savings level. If what you want is smooth consumption. So I'll pause there because I want to hear your reaction, Jay.
Well, I read the article. I read both articles. I read your article and I read the original report. So I thought that what was interesting about your article at the end was this seemingly innocent sentence, which is that a lot of that is certainly empowered when interest rates are zero.
Mm-hmm.
Right. But now the opportunity cost has changed. Right. Notably, right. 2-year note now 4.6% for US Treasuries, whereas even just a year ago, you're talking about what, a quarter, 0.5% at
0.2, yeah.
Or something like that. So now all of a sudden, this is kind of where I wanted to go on all the different like craziness, which is now the assumptions we've used for lots of things, is now rightfully challenged, I think. And I want to see I'm going to want to see what your other counterparts, I'm one of your counterparts where I'm giving you, particular sound bites about a particular topic.
Yeah.
You've got a whole stable of Jays, who are giving you different types of opinions on and guidance for your audience. That, I think that a lot of this is going to be challenged really from the ground up, because really since the great financial crisis, or literally most of the living people's lives have had a one-way train rally in the bond market.
Yeah.
One way. I mean, it's been basically unabated, other than the great financial crisis, just because everyone thought the world was going to end briefly. And then, before TARP, and then the bouts of a bull run in the bond market has really been uninterrupted outside of these, and they were fairly confined, right? I mean, and there was an action which immediately fixed it. You know what I mean? In other words, the Fed threw a safety net to the banking system, right? And then basically said, okay, no matter what, we're gonna backstop the banking system, period. And even if they tried to let Lehman go, that didn't work. Right? They said, we're not going to let that happen again for AIG. Right? I mean, they said, okay, that's we're not going there. I mean, basically, so like no matter what, we're not going there.
Yeah.
But now I'm not sure what the fix is here to get interest rates back down, to return back to that mindset that has been ingrained for decades. Do you have any idea?
I no, except for the Fed increasing interest rates until until the economy comes to a grinding halt, right? Although Powell did say, no relation, that we're watching this closely and we'll be looking for signs of the economy cooling off. I think it's almost an impossible task, right, to ratchet up interest rates and sort of strike that balance between like raising it to the point where it slows down enough so that interest rates come back down. I don't know how you do that, but I wish him luck in that regard. I do think, though, what's interesting is, for the past, 20 years or so, it seems like everything I ever wrote or everything I ever read always began with the phrase zero interest rate policy, right?
Yeah.
Like, how do you invest in a zero interest rate policy environment? And that was sort of like a mainstay of every webinar, of every research report, of every conversation I've ever had. And now that's changing, right? How do I invest in a rising interest rate environment? And what I think is interesting, and I'm not sure it gets talked about enough, but certainly I've seen enough people say, "Oh, this is a great time now to invest in bonds because yields are at 4 or 5% in the corporate world, whatever it might be, and now at long last I can get a coupon that is worth investing in." To which I might say, well, real interest rates during the zero interest rate period, like let's say if risk-free rate was at whatever 0.25 and inflation is running at, what was it running at, 1-2% or so,
Right.
right? You were looking at a real rate of negative 1.5 maybe, and now we're looking at inflation running at 8% and a risk-free rate at 4, and so we're looking at a real rate of what, -4. So you're still losing money in a way, aren't you, if you're investing in a long bond with a 4% return? It's not like you've got to use real money to pay for real goods, right? So you're not
It's
keeping
a
pace with
conundrum.
inflation necessarily, huh?
Yeah, it's a conundrum. I mean, like you said, I'm not sure how they thread this needle. Like you pointed out, it's pretty unlikely. I've already looked beyond that, meaning that excuse me, my issue is, let's say, for example, the cost of index is 100 and now it's at 108. That in a year these high prints are going to start rolling off.
Mm-hmm.
And you're going to have lower prints. Inflation is lower.
Yeah.
But it's still starting at the base of 108.
Mm-hmm.
So if it goes up by 4%, right, it's 108 times 4%, which is still nowhere close back down to 100.
Yeah.
You see what I'm saying? In other words, the cost.
Right. And I think you can't unwind the wage growth either, right? You're going to tell someone, oh,
Yeah,
it's slowing, so I'm going to, cut your wage to a place, right? That's not going to happen. So I'm afraid we're in a rock hard place in a way.
I've got one more, which is that which kind of has to do with the controversy we're having with China, which is
Mm-hmm.
that, and I've made this point to a couple of friends of mine. I'm saying, the export from China is actually deflation. And if they stop exporting deflation, right? Because they've had a fifth world economy go to the first world,
Mm-hmm.
in a blink of an eye.
Yeah.
And the way they've been able to do that is because their wages have been so low, and therefore they've been able to make everything for a much cheaper price. But now all of a sudden, if you cannot do that even if the Fed does make monetary financial conditions tighter, I'm not sure that that's the whole story either.
Mm.
Which I'm not sure. I don't think is out there in the press, to be candid with you.
Yeah.
In fact, it's the first time I've said it out loud on a recording that, and I got this because I was in Asia at a lunch with a person from an economic think tank in this Asian country, a prominent one. And we were having this rhetorical conversation, Socratic conversation. He's PhD at a think tank, there's just me,
Yeah.
well, I spend time looking at screens and, thinking about, fixed income derivatives. He said to me, okay, what do you think that China has done the most? And, kind of like as a quiz to me. And I'm just thinking to myself, well, they've increased velocity because of all the extra people who have, moved from the farm to the city.
Mm-hmm.
He said, yeah, that is true. But he was the person, he said, they've exported deflation.
Mm-hmm.
That while all the nominal GDP has grown globally, that price index of the globe hasn't really increased. And why? 1.7 billion people pushing down inflation.
Yeah.
And what happened, and now this was a long time ago that we had this conversation that I remember, that this person, this scholar from this think tank was like, that at some point is going to be an issue, because you need to remember that China does not consider itself like the United States, where we are considering, the long run is this coming Friday or third
Like next quarter's annual right earnings report, whatever. Yeah.
the next CPI print or something like that. But
Yeah.
to China, the long run is decades,
Yeah.
decades and decades, and so it'll be interesting to see. I don't know. I'm not sure. I candidly don't know, and I want to get back to your paper and your observations
Yeah.
because
Okay.
it's so easy for the two of us, Bob. Because we've got your sound clips.
Yeah.
And we're trying to meet certain parameters, and now all of a sudden we don't have these barriers. And I'm
There's
like,
so
oh
many
no,
off ramps here, Jay. Sorry.
no, quite okay. So one of the things that I was thinking about your life cycle article, which I didn't necessarily disagree with, right? Because of the fact that I've been trying to say to persons, sorry about that, is the fact that we're assigning different utility to the money.
Mm-hmm.
And that is part of this life cycle. On the academic part of the paper, I'm not sure if you mentioned it in your article, but on the background report of the study was the fact that people are getting different use of the money when they're at a younger age. So 29-year-old Bob Powell used that money and got a certain satisfaction quotient, whatever that quotient is.
Yeah.
And there's certainly things that we could do when we're in our 20s, early 30s that you cannot do at 64.
Yep.
For example. And how do you really equate that? So that kind of back into your life cycle, the fact that you want to be consuming.
Right.
Kind of like for smooth consumption, because at those points in time of your life, you're getting enjoyment factors that you will not necessarily be able to replace later, much less that you have to be in condition to enjoy it, right?
Yeah.
I mean, which I think was the back end of that paper, right? Of the paper itself, which is that why is, actual spending declining to some degree,
Yep.
at very late stages of life.
Yeah.
And so,
Yeah. And
I thought
that was
that was
like, that
interesting.
was an interesting thing, right? That, one of the premises too, at least by the folks at the Rand Corporation, Michael Hurd is the person I spoke to, was this notion that, maybe we are oversaying. So the thought is, okay, so you get to retirement and spending declines on a real basis, and most funders are projecting that it's going to rise on an inflation adjusted basis. So what happens if and other studies have done this as well. Blanchett has done it, Boston College, JP Morgan, several other groups have said, hey, look, spending declines on a real basis in retirement. So one possibility is that we're oversaving. The other is, like you mentioned, utility changes, right? Early in retirement, maybe you went to Europe on a month-long vacation, but late in retirement, well, I've already done Europe. I don't need to do it again. So I'm not going to derive any utility from doing that again. And maybe I'll derive utility in spending it in other ways, or not spending it at all, right? Because I don't know what satisfaction I'd get from if it's not a trip to Europe or a trip to Central America or taking my grandkids to Disney World or whatever it might be. Everyone's utility is going to be obviously different. But it does, spending declines. So we need to also accommodate for the possibility that maybe if not, we haven't oversaved, we may be either reducing our ability to spend in retirement or creating a large bequest that we didn't intend on.
No, exactly. This is what I'm saying is that I've said this to financial planning clients that they've entered retirement, and if we've kind of agreed they have the sources required, that they've thought through, they've turned over the rocks for the number of scenarios that they could reasonably predict, even if that was that they could not take care of themselves, that I'm like, look, if you're going to, please don't tell me about your plans to go on a vacation. Just send me a postcard from when you're there.
Yeah.
Because you don't know, especially early in retirement, that you're not exactly sure that you're going to be in the physical. You may be a medical situation, restrains you from taking that trip.
Yeah.
So, your utility difference, really can matter a great deal. Not even talking about the fact that if you're confined to your home, for example, can't go out to eat and things like that or whatever to the same degree.
Yeah.
So and I thought that the life cycle article was interesting because it points this out, that it can also extend to other age ranges, right? And especially because, and I tell people from Jay's Corner that, what a disaster I'm having in writing a second book. And part of it is because, and you actually pointed out, and that's kind of, we're going to end this segment, which is that the way that people earn money now as a 30-year-old is so different than work at General Electric, have career advancement, get increased salary, also a pension, for example.
Yeah.
Right now, all of a sudden, that entire process is now basically gone. I mean, something like 20% on defined benefit, and those are largely civil service, government type, jobs, whether it be VA or state or local government. And so now we've got this different course. So I'm wondering if that article changes because of the fact that, I'm not sure about your son, but if I'm 20, I've said this to other people, if I'm 18 years old, am I going to college even? I don't know. Or if I'm figuring out how the social media algorithms work,
right,
for 2 years, and then foregoing on college. You see what I'm saying? Like the entire life stages now are all kind of mucked up.
Yeah.
Because of the fact that the D'Amelio sisters, $20 million each for 2 of them.
Yeah.
In a year. we don't need 5. They don't need 5 good years.
Right.
And you can't think their window of opportunity is going to last every single year for the next 20 years.
Yeah.
So, rationally, and the barrier to entry is so much lower.
Right.
Right. I mean, Ray Bork was a gifted athlete for a long time, right? I mean, a lot of filtering had already occurred. You see, and I'm not going to be a professional athlete. I knew this, when I was like, 5. But I could have been a TikTok star at 5. You see what I'm saying? In other words, or that could have been on my horizon.
Right. Right. And I would never have, and I wouldn't necessarily advise my kids to go try to become TikTok stars because, I think sort of like winning Powerball a little bit. Like, I don't know, who's going to be holding a steady cam while they're riding their skateboard, to Rihanna, right? Or whatever. Fleetwood
But
Mac.
it's a lot more, right? I mean, it's a lot higher probability now. It's not nearly like the YouTube algorithm thing is like crazy.
Yeah.
Right. These persons are making hundreds of thousands of dollars a year for not that many views.
Right.
Not that. I mean, it's a lot. I'm not talking about Mr. Beast, that kind of thing, but I'm talking about even just run of the mill channels. There are now solid income streams that young persons can make, where the idea of a corporate job for that same person may not be the rational path.
Yeah.
And as a result, now the entire life cycle, that paper, etc. I'll be fascinated because, unfortunately, we're not going to have a new life cycle paper until after looking back at the different.
Well, that'll be an interesting
choices.
one to look at, I think, right? Because everything has been upended. Even the point that you made about college, right? I think about conversations I've had with Joe Coughlin over at the MIT Age Lab, who talks about this notion of lifelong learning and people getting certificates or, sort of mini degrees that at least speak to some specialized skill or knowledge or experience that they need to advance in their career or to understand the algorithm of YouTube.
Yeah, and the thing is that could be rationally, the EV, the expected value of that investment in time, may be superior to college for certain persons. That's what I'm saying. at this point, right? I mean, because now you've got college at this price, assuming that, not all loans are forgiven, right? And things like that. But, we won't settle the politics of that. But when you can't do that, I don't know. Well, it can be, since the barrier to entry is a lot lower, and the possible path to income for a new generation can change it, I think. And I'd love to see what the academics have to say about this, right? Because the academics have been saying for decades that college is still the best path for future income and life and longevity, et cetera, et cetera. On average, that college degree is worth the investment. But now social media, I'm not sure if that has flipped around or not. I just don't know.
I don't know. I'll tell you what, Rich. I posed this question to Richard Thaler, right? Yet another Nobel Prize winner, author of Nudge, University of Chicago, right?
Okay.
And I talked to him about the life cycle paper that I had just written about, and I'm like, "What's your take on it?" And ultimately said, young people should invest in their human capital. He didn't say college per se, right?
Yeah.
He said invest in your human capital because that's where your biggest return will be. And so that could be any number of things. It doesn't have to be college.
And I think that that's a great way of putting it, right? Because now it used to be that college was the only spot, but now skilled trades, be more viable depending on the person. And now we've got this whole other thing where now you can reach a globe. So it has to do with the life cycle and the fact of interest rates, because to bring us full circle, as I thought about, I even think that while it's true on average, certainly, that even things like Social Security, delaying Social Security, now all of a sudden the return for delayed credits, right, is the 8 units.
Yep.
But now if I told you that the yield on the high yield index is 6-7%, and it's not, and you can compound that, and then when you couple that with the life cycle utility question, you see what I'm saying? In other words, the entire decision-making process with a different interest rate regime looks different to me, or might. It doesn't change the math of 8, because of the 8 units a year.
Right.
But it presumed a bunch of things, right? It presumed, well, I'm going to live to X years.
Yeah.
And it makes no mention of the utility.
Yeah. So I think, Jay, you raise a really interesting question, right? When I think about the financial planning profession, and I'll quote Zvi Bodhi, former Boston University professor, now emeritus, who would look at all the research that was done by financial planners, non-academic financial planners, and he would refer to it as junk science. And in part because it was largely anecdotal, right? It wasn't sort of true academic research. And I think what you're pointing to is this notion of applying academic rigor to the exercise of trying to determine what's the best course of action, right? Delaying Social Security or not, right? Taking Social Security and investing that benefit amount in high yield bond fund or whatever it might be, right? And what's the utility of the, right? I mean, I don't think anyone's going to that, the financial planning profession, by and large, isn't going to that level of analysis to come up with the answer.
Yeah, and then, of course, every person's different, right? I mean, because then you've got a different person with different risk tolerance or different priorities, et cetera, to layer on top. So what we've got is a bunch of, and not to say that delayed retirement credits is wrong, right? I mean, it's mathematically correct, obviously. And it's not changing anything about, optimizing if you're a married couple and things like that. That part I get. All I'm just saying is that now there are these other factors. The utility factor always existed, right? And then, but now as a result of higher interest rates, now all of a sudden, because of the fact it can yield something, that can change it. Whether or not it's big enough to change it at this level, I don't know.
Yeah.
Right. Or maybe it doesn't change your mind at all.
Yeah, I think it changes the discussion, but I would, hasten to add that it needs to be discussed in terms of real interest rates, not just nominal, right?
Sure. No, yeah, no doubt about that. I mean, that one I'm not sure. Um, I don't know how we get to real. Well, the Fed has said we want to have so that the real rate is positive.
Yeah.
If that's going to be the case, that's my issue. If that's what you want, and China stops deflating, and now we still have these bottleneck, some bottleneck, or maybe they're getting better, et cetera, et cetera. How do you get to a real rate that's positive?
I don't know what would that be right at the moment, 11%, give or take.
Yeah, I mean that means you're gonna. I'm not sure how you're gonna stop raising
Yeah.
until you got to that point. So
Yeah. Well,
I
the
just think
interesting thing, I'll share this one last thing. I'm reading The Lords of Finance, which is, documents the 1920s and what the central bankers around the world did at the time to either cause the depression or then try to get out of it. And it's a fascinating history because, what were the tools available to them? The same tools that we have today, right? Raising and lowering, Fed
interest
funds
rates.
rates, and with the same results.
You're right. Right.
Hopefully there's not a depression on the horizon though, Jay.
No, no. Well, I think, yeah, I don't even want to go entertain what would happen. I do think that there's probably going to be some turmoil because what you saw in the UK, it was pretty dramatic. Although, and then I'm not sure that whole episode is over. I'm not sure what happens in your life, Bob, to Bob Powell. So you get these big headlines. I mean, you've got your normal work at on thestreet.com and Retirement Daily. And, we'll have a link in the video and things like that for people to, explore. But now you have a big market change, etc., or event. Do you get calls or pitches for articles, or what ends up
Oh,
happening?
countless. Yeah. I mean, every time there's an event, the inbox is filled with emails from typically the PR person representing some institution, advisor, research entity saying, we have someone that can comment on the Fed, doing this, or we have someone that can comment on, China's supply chain or whatever it might be. There's a countless desire on the part of professionals to get their voice out, and through mediums like myself and my peers in the world of financial journalism. So I'm never at a loss for sources. What you may always be at a loss for, though, is sort of genuine, objective, earnest, right, sources, and that's always been the hard part. Not the hard part, but it's certainly one of the challenges, especially with unsolicited emails. Like, I've never spoken to John Smith about whatever, and how am I to trust him and then quote him for the benefit of my readers who want to be enlightened.
That's tough.
Well, so it's
I
tough. And
can't
also,
imagine how many
yeah,
emails you get with these pitches.
yeah, a lot. But the good news is, like, once you find someone, so you and I have developed this great relationship, right? And I can't recall off the top of my head how it came to be. Maybe it's because I noticed that you'd written the book and I reached out. And then over time, we got to know each other. I get to understand your point of view, get to trust the knowledge that you have like zero fear about sharing your knowledge and wisdom with our readers and viewers. And so once you find a good source, they become a go-to, right? It takes a lot of the hassle out of trying to figure out who to turn to when you want to write something.
In all your inbox emails for pitches, I was wondering, does anyone think that and that event in London or in the UK coinciding with the Queen passing away, and the turmoil in their internal politics, was it your sense from the pitches that you got that that was just an example and there's got to be more out there, or was there no real mention of it and just like, oh, everyone kind of just shrugged their shoulders? Do you remember?
Yeah, I mean, so there's a gentleman I follow. His name is Jonathan Payne. He's out of Australia. He's a Brit originally, and he was worried at the time, and he continues to be worried. But he's also unsettled by the fact that others aren't paying attention to the possible long ripple effects from that, and trying to
Yeah.
examine whether other pension funds, insurance companies had the same sort of exposure. I mean, it didn't, obviously, Bear Stearns and AIG, and what we witnessed in '08, what we witnessed with long-term capital, right? I mean, we haven't seen that sort of sort of snowball avalanche effect yet, but maybe it'll still happen yet. Maybe it'll happen a little bit more slowly. So I think we need to be watchful of that.
I was shocked when, I knew that there was a problem, or when everyone else did. I was shocked to see long dated inflation gilts minus 18% in a day.
Yeah.
I'm like, that can't be great.
Right.
And like the person, you'll share the link of the person in Australia. I
Yep.
probably share that. I mean, it's very unlikely that this was one party, right? Because the broker dealer community has ported out this same technology to other parties,
Mm-hmm.
and it wouldn't be limited to the UK only either.
I don't think so.
It cannot be.
Not in a world where everyone is searching for yield, right? And much like happened in '08, right? With right, all the collateralized debt obligations, right? Everyone was like, oh, grasping onto this technique that allowed us to, juice the yield a little bit, right?
You would think. So I'm very curious to see what ends up happening here, because of the fact that, with that in currency, that you have these other parties who have been trying to get this extra yield to meet their pension obligations, right?
Yeah.
Which there's this yield gap, which just normally would, or naturally occurs when rates are that low for that long.
Yeah.
You've got this disconnect between your liabilities, which you've promised to pensioners, versus, well, how are you going to get this return or this cash flow?
Yeah.
The only way to do it is by levering yourself to some degree, yet not want to say, well, I'm like 5 times levered the equity market. Or, right. So you had to be levered in some other market.
Yeah. I don't know how they slept that night, Jay.
Well, when you're short vol and there's no volatility, you wake up and it's fine.
Yeah.
I mean,
Yeah.
it's
Yeah.
fine when it's not volatile, but when when stuff become volatile on interest rates, and then the ripple effect of foreign exchange, now all bets are off.
Yeah.
I don't know. We're too far removed from the African countries or Latin American countries where Venezuela is at 100%, 100% inflation.
Yep.
When things run out of control, and not that that's going to happen in the United States, but a trading partner of the United States, that could happen to.
Yeah. Very easily. I think what you're suggesting to a degree also is that people should take a class in behavioral finance if they haven't already, so that they're not prone to recency bias or confirmation bias, and right, and that might help a little bit. Think that tomorrow will be the same as today, which we know it may not be, right?
So, on other topics, Bob, we've talked about healthcare a lot. How much of your day you got lots of topics on your retirement daily. And the last time we talked about, the fact that ESG was a big was a big topic that you had received a lot of interest in. What are your big topics for Bob now?
Well, I think
inflation, or
I'm sorry, say it again.
Inflation or
yeah, certainly inflate. I mean, different topics for different markets. So I think in the advisor market, there's been a great deal of discussion around how to incorporate private equity into a client's portfolio, and we're even seeing at the Department of Labor, discussions about adding private equity right into asset allocation funds as part of a 401k investment menu. And again, right, it's this search for return. It's the search for maybe an uncorrelated asset. There's been a good deal written about how maybe private equity has, provided better returns. There was a story recently about how had CalPERS, right, the big California pension plan, had they invested in private equity, what their returns would have been had they allocated even a slightly larger portion to PE. And so I think it's a really interesting topic. I don't know, the degree to which PE will become democratized, but I think it's a ever present and ever growing part of our investment landscape that needs to be, written about, talked about, discussed, because I don't think it's going away anytime soon. I think it's here to stay, especially in a world, Jay, where we're looking at, the public markets shrinking, right? And so, people are looking for returns perhaps outside the public markets, given, the shrinking number of opportunities in the public market. So
Yeah,
that's
I
one.
don't know how we get over the information disconnect to get so that people could actually understand what, and people don't understand what a bond mutual fund is. Right? How are you going to get them to understand what's going inside of a private equity fund?
It's a
You know,
tall order, right? It's
right? Because you're talking about 401k, you're talking about the advisor signing their name to the fact that it's included in the menu and things like that. I don't know. I totally understand how the CalPERS of the world, the big institute, they've got their due diligence teams, et cetera, et cetera. They can hire the teams to ask the right questions of the private equity funds. Okay, what's inside here?
yeah,
Tell them, we're CalPERS. They'll get their answers.
yeah, right, right.
Whether or not, Bob and Jay's machine tool manufacturer gets the right answer
Yeah.
for our 401k, contributor beneficiaries. I don't know.
I don't know. I mean, I think the premise is that if you're Fidelity or Vanguard or T. Rowe Price, you're adding PE inside a target date fund, let's say. And so maybe it's, 3 to 5% of the target date fund that someone will get exposure to. My question then is, I think, is it worth the risk, and what kind of return, what kind of risk adjusted performance are we going to get by adding 3 or 5% PE to someone's target date fund, which already probably has 10 mutual funds in it already, right? Probably has a large value and a small cap growth and an international and a right junk bond and a floating rate bond, and who else knows, right? I mean, there's just a lot of funds inside a target date fund. So adding one more investment option at 3 to 5% of the asset allocation generates what? I don't know, 0.01% increase in the potential portfolio performance. Don't know.
Yeah, right. And I mean, I think I've spent a fair amount of time in Jay's corner actually looking at target retirement funds just to see, what's underneath the hood.
Yep.
Meaning that when people go to a robo advisor, they go to their stockbroker, they're given a portfolio which may or may not be tailored to them. It may be a generic, diversified portfolio with certain inputs.
Yeah.
And of course, this year has been, which I knew from the time that we spoke last, which was the GameStop period. We
Yep.
spoke immediately after AMC GameStop. We actually talked about it.
Right.
And that was, for me, something was screwed up in the entire portfolio management, or meaning that the modern portfolio theory, meaning that the different asset classes started to behave very strangely compared to each other.
Yeah.
And literally at that moment, I said, okay, I need something other than the Maximize Your Medicare newsletter. I need this other avenue here to say, look, there are these other topics that I've been talking about under Maximize Your Medicare, but people pigeonhole me there, so we need
Yep.
this other thing.
Yeah. So that's, the other interesting thing, you mentioned the meme stocks, which we talked about back then. I think Bitcoin was probably trading around $50,000 or $60,000, maybe, give or take.
Right.
And now no one wants to talk about Bitcoin. No one wants to talk about the possibility, as they did back then, that it's a inflation hedge.
Yeah.
Right? Which is proven to be not quite true. And
right.
A lot of people whose Bitcoin or whatever crypto portfolios are down, what, 2/3 maybe, give or take.
Well, then since then, of course, Luna occurred, and that money's completely gone.
Yeah.
So we've had some certain bouts here. It'll be interesting to see. Like I said, that's why I was asking you in terms of when you get pitched, when you get people bring you ideas or what trends Bob sees, because you're going to see certain things that your stable of trusted people or people proposing things. If you're seeing, so you're seeing PE, nothing on precious metals because the yields and alternatives too high, generally
Yeah,
speaking.
nothing on precious metals, Jay, I'm afraid to say. Let's see. I think there's certainly a growing debate, right, around, we talk a growing debate around inflation, right? And signs looking out a year from now where the indicators suggest that, maybe we've peaked at 8, right? There's a certain sentiment on the part of folks that are, again, relying on, spreads and between different instruments to say, I think we
Sure.
may, the forward looking, view is that maybe we peaked. Um, I don't know, right? I mean, no one has a crystal ball on that one, but imagine if we did peak. What does that mean for your investments?
I don't know. I don't know to peak to where.
Hmm.
Again, my question is for everyday people, right? We've still got a basket of goods now costs 108. So we've peaked, but does that mean that, and now your wages, or you get laid off, or you don't get laid off, or whatever it would be,
Yeah.
are you better off really? Because in order for you to get better off, it's not the rate has got to decline. It's
Right.
got to decline so that you can afford more. So how do you do that? 108 can't, if it keeps going, it goes from 108 to 6% higher the next year. Are we that much better off? Now that basket of goods is going to be what? It's going to be what, 115 odd.
Yeah.
You see what I'm saying? So now are we really going to be able to get wages to match up with that? That part of these types of questions, I don't know. I don't think that we've fully flushed out because we're so ingrained on inflation basically being zero.
Yeah.
I mean, the improvements in technology made up for whatever price increases, there may have been.
Yeah.
Even though chain CPI is, the idea behind chain CPI, existed, which is, that the improvements of technology outstripped the nominal price increases.
Yeah.
But
Yep.
now
Yeah.
it's just very, very difficult to see.
Yeah.
Last thing, and this is the thing that we've not talked about on your channel, because we're careful to not be too biased. You see what I'm saying? We're not introducing, but we share. So for the audience, we share emails on different topics, and Bob sends me emails on topics, and I'm like, oh boy, I'm not going to touch this one.
Just fishing.
Yeah, the embers are glowing on this on the edge of this iron. So no, I'm not. I'm gonna. We I get asked Medicare Advantage versus Medigap all the time,
Yep.
and I'm sure you've seen articles written by counterparts of
Yep.
yours, articles by academics, and that I relied on and will continue to rely on good sources, Commonwealth Fund and Kaiser Family Foundation as very good, by people who are quite rigorous. And then
Mhm.
not only that, trying their best to keep partisanship out.
Yeah.
That said, not the rest of your colleague, your of
No.
journalism is like this. What's your take here, Bob? I mean, you're a media person. I'm just a guy over here, I guess. What's your take on what you're being told or how we are being told about Medicare and then the way this stuff is marketed to us?
Yeah, I think my take is that it's as complicated a topic as anyone will ever have to deal with, and then have to deal with over the course of their retirement, in a time when maybe they're experiencing cognitive decline, right? So it just, I think it speaks to the need for people to learn as much as possible, as early as possible about it, and then find maybe trusted resources, Jay, ultimately to help them guide them through this process, because left to their own devices, they're unlikely to make a change to their plans once they're enrolled, as you well
Sure.
know. And they're unlikely to know about everything that happens. I think one of the stories I sent to you was a New York Times report that was looking at Medicare Advantage plans, I guess for lack of a better term, upcoding or adding codes, right, so that they could charge the government more, for the beneficiaries that are enrolled in their plans. And maybe that doesn't hurt the beneficiary real time, but maybe over the time it does, because it's becoming a bit of a inflationary, right, potentially inflationary endeavor to add codes or upcode patients, unbeknownst to them, right? Because they're paying maybe $0 or a nominal fee per month, and they don't know that their insurer is now sending an increased bill to the government for services that they didn't know they were getting, or being billed for. So that's just one example of, like, we don't know what goes on behind closed doors, and so we need people like you. We need investigative reporters like those at the New York Times to expose things that people need to know about. What I do find interesting, Jay, is that I'll just share. I had so Medicare Advantage right now is what, 50% of the enrolled beneficiaries, which,
For all intents and purposes,
yeah,
50%. That's right.
and it's grown tremendously, right? It's been remarkable, its growth. And I sat down with a former college roommate of mine who just turned 65 and enrolled in Medicare Advantage, and really said he read a number of things and then thought it was unlikely that he needed Medicare and Medigap, because there's no way that he would ever experience the cap on his Medicare Advantage plan over the course of his lifetime, and that on a cost benefit analysis, he said it was far better for him to be in a $0 MA plan than in original Medicare and Medigap. And he didn't understand why anyone would ever feel differently. And I tried to explain to him the reasons why you might choose, original Medicare and Medigap, but I think it was lost on him. It might be lost on many people because of the appeal of a $0 premium.
Yeah, I think that, I'll stick with this, which is that I think that they both can coexist, right? Which is that, if you're like you or your friend, right? If he believes he's Mr. Perfect, that he's right. And I've got persons that were on Medicare Advantage from the beginning because they were in exceptional health and they didn't have financial resources, and some of them did. In fact, I can remember a couple saying, look, the reason we're able to retire is because I was very thrifty at every point.
Yeah.
Right. In the way I'm reason to retire today is because I have resources that resulted in the fact that I looked at matters carefully and chose, thrifty to save.
Mm-hmm.
And while I understand the risks involved, that $3,000 a year of lower premium that I would have to pay is worth it.
Yeah.
And some of these, and oh yeah, by the way, I knew that 10 years ago. So now I've kept all this money of $30,000 during this, and it's more than 30,000 because Medigap would be more expensive now.
Yeah.
And now then, in fact, and this is unfortunately part of the way that we get told, given information, where we're given our little sliver of information. Yes, in that year that you went to the hospital, yes, the nickels and dimes of Medicare Advantage can add up to be greater than your Medigap premium. I don't think there's any doubt of that, even if, and maybe subject you to the out-of-pocket maximum, but that's not the only year. These articles, and maybe you and I can do a better job of that, is to point out, we're thinking about multiple years.
Yeah.
It's not only the singular year. And that's for Mr. Perfect, the person who's always going to hit the out-of-pocket maximum every single year. Well, that's different, right? I mean, that's now the higher premium for Medigap is, very, will pay for itself, if you will, because of its stability. Is it your opinion that our sound clips have to be more about advice and or we're pretty careful between
Yeah.
us, to be as neutral as
I
possible.
yeah,
What
I
kind of
think that
feedback do you get?
yeah, I mean I think I'd liken it to a piece I once wrote about annuities, and I clearly wrote about the pros and cons and who they were for and who they shouldn't be and who might not consider them, et cetera. And I felt that was a really balanced educational piece. And in the comments section underneath, someone wrote, "What are you, a shill for the insurance industry?" And I thought, did you even read the article? I mean, I
Yeah.
didn't give advice. I was just explaining what this was and who might use it and who might not, and pros and cons, et cetera. And I thought that that's my role is education, right? I've always thought that that with anything, it's like there is no silver bullet, there is no one answer, right? People have different points of view about what tool or technique to use or what product to use. The best we can hope for is to arm people with enough information that they can, if not make a decision on their own with what we've written or said, that they have the working knowledge to talk to a professional about this, right? And that's always been my motto, I think, Jay. I've always said, like, part of my hope is that what I do is takes people from street level to curbside to advisor's doorstep, right? That I've armed them with enough information so that their eyes don't glaze over when someone mentions maximum out-of-pocket cost on your Medicare Advantage plan. There, that should not be a surprise to them if they were to walk into an office like yours and someone says that. So that I think that's I think it's hard for me to think that I should be telling people what to do as opposed to telling them here's what they need to know.
And we can close there, Bob. But thank goodness I'm of the sigh of relief because I'm not I'm not a willing participant of or a citizen of Hot Take Nation. That's just not.
Yeah,
I know that
maybe if
gets
we
the
were
clicks
talking
and
poker,
attention.
I don't know, maybe something then.
Maybe in a different lifetime I'll get reborn in that way and things like that. All right, Bob. Thank you so much for joining. Always great to talk to you. We have a great time on our monthly, but
Yeah,
the reality is, this gets to see other people get to see a different side of the legend, Bob Powell.
I so enjoy this, Jay. Thank you so much.
All right,
Appreciate it.
thanks.